Let's talk about the risks of retirement. I've spent over 30 years working with retirement planning strategies, and there are several key risks that consistently show up. The number one concern for people approaching retirement is running out of money. Longevity and inflation are very real risks. Number two is the stock market. Sequence of returns risk refers to taking money out of your investments during a market decline. Taxes could become your largest expense in retirement unless you experience a long-term care event. And finally, legacy planning for a surviving spouse. Let's begin with the market. There are valuation measures that investors often reference. One is the Shiller cyclically adjusted price-to-earnings ratio. Historically, its median has been around 15.83, and in recent years, it's been well above that long-term median. Another measure compares total market capitalization to gross domestic product, sometimes called the Buffett indicator. That measure has also been elevated relative to historic norms. While valuations cannot predict future market performance, they can provide perspective. When markets are priced above historical averages, caution may be prudent. The late 90s were extremely strong due to speculation around the internet. Then in March of 2000, the correction began. The following year was 9/11. By 2002, the market had declined approximately 47% from its peak. The market recovered, and then in 2008, we experienced another major decline of about 37%. Over the 20-year period from 2000 to 2019, the average annual return was approximately 5.146%. This brings us to the 4% rule. The idea was that you could safely withdraw 4% of your portfolio each year in retirement and reasonably expect your money to last. However, more recent research has raised questions about how reliable that rule may be in volatile markets. Let's consider a hypothetical example. Suppose someone retired in 2000 with $1 million and withdrew 4% annually for income. Even though the market averaged 5.146% over those 20 years, because of the timing of major losses and the ongoing withdrawals, that $1 million would have declined to approximately $345,652 by the end of 2019. This is sequence of returns risk. That is the impact of taking distributions during significant downturns. Volatility combined with withdrawals can permanently erode principal. This is why we focus on creating guaranteed income strategies for our clients. If that same individual had a guaranteed 4% income stream, they would not have been forced to withdraw from a declining market. In certain structured scenarios, the original $1 million would have remained intact while still providing income. I've conducted retirement seminars since 1997. During the 2008-2009 financial crisis, I met many people who lost so much money they had to return to work. I also met people who wanted to retire but couldn't because of their losses. Historically, markets move in long cycles. There have been extended periods of strong growth, followed by long stretches of flat or sideways markets. For example, the S&P 500 was at similar price levels in January 2000 and in January 2013. When markets stall for extended periods, drawing income becomes much more difficult. Now let's shift to taxes. The highest marginal tax rate in the U.S. history was 94% after World War II. In the 70s, the top rate was 70%. Today, the top federal rate is 37%, which is a low historical level. However, tax laws can and do change. If you have significant pre-tax retirement accounts, IRAs, 401ks, 403bs, SEPs, simple plans, taxes may become one of your largest retirement expenses unless long-term care becomes a bigger one. Long-term care is expensive. The average need is often cited at around 4 years, though some individuals require care much longer. I have a client whose mother was in a facility for 8 years. Research suggests about 70% of women and 50% of men will require some form of long-term care. Costs vary by state, and Washington is among the highest in the country. Finally, legacy planning for a surviving spouse. When one spouse passes away, taxes go up and income goes down. Taxes increase because a surviving spouse moves from married filing jointly with 2 standard deductions to single filing status and 1 standard deduction. Income may decrease because the survivor keeps the highest Social Security benefit. If pensions are involved, those are often reduced to 50%. These are real risks. So my question for you is this: which of these concerns you? Longevity, inflation, the stock market, sequence of returns risk, taxes, long-term care, or legacy planning for a surviving spouse? People are more successful in retirement when they have a comprehensive plan. We help clients create holistic plans that integrate retirement income, tax planning, estate planning, and strategies to manage the risks of retirement. If this resonates with you, I invite you to schedule a strategy session.